Remember back in 2021 when institutional fund managers were buying up all the single-family real estate, homes were selling hours after hitting the market for 50 or 100 grand above asking price? Well, that may be about to change because Starwood Capital Group, the owner of one of the biggest real estate investment trusts in the country, just announced that 2,000 of those houses that they bought back in 2021 are going up for sale. And with liquidity in the housing market at lows we haven't seen since the height of the global financial crisis, there's a good bet that that means home prices are about to start coming down. What's up, guys? I'm Nobody Special, and this one hit Bloomberg on Tuesday of this week. Sternlicht's Starwood eyes sale of more than 2,000 rental homes. Starwood is seeking to sell houses that it acquired in 2021, and the firm is a major owner of rental properties in the U.S. Starwood Capital Group, led by Barry Sternlicht, is exploring a sale of more than 2,000 single-family rental homes. Many of the homes being offered for sale by Starwood Real Estate Income Trust are part of a portfolio that was acquired from Pretium Partners in late 2021. Pretium is reacquiring about 100 homes, people familiar with the matter said, and the homes are not being offered at distressed prices, and it's possible that Starwood holds on to the bulk of the homes, the people said. So this isn't a fire sale. The prices aren't crashing, at least not yet. S-REIT owned 3,210 single-family rental homes valued at $1.26 billion as of March 31st, according to the filing. So they own 3,210 single-family homes, and they're exploring the sale of 2,000 of them. That's more than half of their single-family home portfolio. This is not a minor move being made by Starwood here. They are getting out. They got a big case of buyer's remorse from all those homes that they bought at bubble prices back in 2021. And when you dig into some of the company's recent SEC filings, you start to understand why they're selling these houses. This is their Form 10-Q that was filed at the end of last quarter. And it's on page 7 that you get into the juicy stuff. Up here, impairment of investments in real estate. And you can see there they took a $79.8 million hit in their last quarter from impairments of real estate. And when you scroll down 2 more pages, you start to understand what they're talking about. During the 3 months ended March 31st of 23, the company recognized an aggregate $79.8 million impairment charge on various single-family rental properties. The impairment charge was a result of updates to the undiscounted cash flow assumptions for such assets where the company's expected holding period for these assets changed due to an increased probability of near-term disposition. So what's that mean in plain English? It means when we bought these properties, we thought we were going to be able to raise the rents substantially. It turns out we can't, and these properties don't cash flow like we thought they do, and we're going to have to sell them sooner than we were planning on. And so we're going to go ahead and take an $80 million loss this quarter because we know these houses aren't going to sell for as much as we bought them for. And unfortunately for Starwood, they don't really have any choice in the matter because the investors in this real estate investment trust have been trying to pull their money out for months. And Starwood has been saying, you can't have your money back. Check this one out from back in December. Starwood, like Blackstone, limits investor redemptions from big real estate fund. You see, in real estate investment trusts, they're kind of like banks. They buy assets to offset the money that their investors put into the fund. So when investors withdraw their money, the fund is forced to sell some of those assets, the houses they bought, in order to raise the cash to pay back their investors. So if everybody withdraws their money at the same time, they have to sell so many of those assets that they start to drive the value of those assets lower, and so they have a hard time meeting those withdrawals. And that causes a lot of funds like Blackstone and Starwood to put clauses in their funds that says we can close the exits anytime we want to if we deem it's in your best interest. And that's exactly what they've done for the last 6 months. Well, now they can't wait any longer. These people want their money back, so they have to start selling these assets. They know they're going to lose money when they do it, and so they took that $80 million impairment charge in their last quarterly earnings. So when you look at the company's 10Q and the $80 million hit, and you look at the fact that they're halting withdrawals, you start to understand why they're being forced to sell some of these properties. But let's hear directly from the CEO of Starwood, Barry Sternlicht, about what he thinks about the rental market. Let me know if some of this sounds a little bit familiar.
I think inflation is going to drop hard. And there's a CPI slide that I brought with me that shows why. You know, it is about the rent component of CPI.
You brought a slide.
Yeah, I brought
like a staple.
A whole 3. There you go. So this is really important. The blue line is actual rents. And the orange line is what the government is reporting. And you can see last month, actually, rents were up 0.8, which is almost a 10% rise in rates. And in fact, rents are falling. If you correct for this, and there's a lag in the way the government reports rental data, and this is 1/3 of CPI, it's 33% of CPI. If you just make the correction of +10, which is what they're reporting, to +4, which is what the nation is seeing, it'll take headline inflation from 4.3 to 2.6. Just that one correction. All else being equal, inflation's going down. The PPI is down. You're seeing lots of things coming down. Wage growth is slowing. So the way they do that the survey of households is somewhat archaic. I mean, they started this survey 50 years ago, 1981, before they had the internet. And they've updated it 3 or 4 times, but it's not the way. They could go right online to apartments.com and pick up actual rents that people are charging. They call homeowners and ask people what they could rent their house for. And if the government calls me, I'm hanging up the phone. What you'll see is what the Fed missed was when rates were going crazy in 21, their data didn't show it. So while we thought inflation was through the moon and beyond, they said, we'll keep rates low because there's no inflation, it's transitory. It wasn't transitory. That was 100% the result of all the stimulus packages.
Now, if any of that sounded familiar, it's not a surprise because that's almost verbatim, word for word, what I said in this video just 2 days ago. Hi, Jack. 2 days ago, I said that the inflation that they're reporting in CPI is actually too high and that they are overstating the rate of rental increases in owner's equivalent rent. That is after massively understating it in 2021. And Barry Sternlicht is saying exactly the same thing. That was back in April in an interview he did on CNBC. And so far, he has been exactly right. It's played out just like he said. Inflation is falling fast. Now, I don't want to sound too alarmist here. We're talking about 2,000 houses hitting the market. And while that is a lot of houses, consider that in the context that existing home sales in the United States was almost 4.3 million houses in the last month. So these 2,000 houses alone is not going to be enough to absolutely crash the real estate market. It's not going to happen tomorrow. But take a look here. Look at the number of existing home sales where we're at right now, around 4.3 million homes. And look at the last time we were down around these levels, at the height of the global financial crisis. The real estate market right now is in a very illiquid state. There aren't very many buyers, but there's also not very many sellers because everybody who refinanced their mortgage in 2020 and 2021, they locked in those low rates. They're not going to let go of their houses. So prices haven't really moved yet because the buyers and sellers are both leaving the market together. Well, that's resulted in a very illiquid market where there's not a lot of transactions happening. And illiquid markets are notoriously volatile and prone to violent price corrections if supply and demand get thrown out of whack just a little bit. Now, let's also consider that Starwood may not be alone here. Maybe they're just the first of a long line of institutions that are going to start unwinding these houses that they bought in 2021. If Starwood is selling 2,000 houses, then maybe outfits like Invitation Homes, Tricon, American Homes, maybe they're right behind them. And very quickly, 2,000 houses could turn into 10,000 houses, 50,000 houses, all hitting the market at the same time. Now we're talking about numbers that could be enough to send these real estate values lower. And if you think there are buyers just sitting on the sideline ready to pounce and come flooding into this market to buy up this new supply, check out this article from last month in CBS. Buying a home is cheaper than renting in only 4 U.S. cities. Now, in case you were wondering, those 4 cities, Detroit, Philly, Cleveland, and Houston, congratulations to them. But another way to phrase this title is it's still cheaper to rent in virtually every major city in the country. Only 4 major cities is it cheaper to buy than it is to rent. So that means there's no buyers for these houses at these prices. And although Starwood is saying we're not selling these 2,000 homes at distressed prices, this isn't a fire sale, they're going to find when they put these houses up for sale, there aren't going to be very many takers because it's still cheaper for these people to go ahead and rent. With interest rates this high and with prices this high, there just are not buyers at these levels. And so in order for buyers to show up for these 2,000 homes that Starwood is going to put on the market, they're going to have to bring that price down to the point where the monthly payment on those mortgages is at least comparable to what people would be paying in rent. Right now, it's not even close. So to all you millennials out there and all you first-time home buyers who feel like the American dream of home ownership has been stolen from you by the Federal Reserve and by these Wall Street investment firms, there may be a light at the end of the tunnel, and it may be a lot closer than we think. If I'm right, and Starwood is just the first in a long line of Wall Street firms that are about to start unwinding their residential real estate purchases from 2021, then there is a lot of supply that is about to hit a market that has very little demand. And that means those prices will have to come down until supply and demand fall in line with each other. Now, if this happens at the same time that other things I've been covering on this channel start to blow up, things like the commercial real estate bubble, which could add stress to regional banks that are already on the brink of failure across the country, then we could have a situation where the Federal Reserve is forced to very quickly return to near zero interest rate policy and lower interest rates. So if you don't give up and you play your cards right, you could find yourself on the winning side of a trade where the big dogs in Wall Street get wiped out for buying at the peak of a bubble, and you find yourself in a buyer's market at a time when prices are falling and interest rates are back to near zero. Till next time, live small and dream big.